Welcome to the deep dive. Today, we're going to be looking at the Indian stock market.
Oh,
Using this newsletter from Volatility Coaches of India,
sounds good.
they have some interesting, they have return projections,
Right.
advice for specific sectors,
Right.
and something called RVCC parameters.
Okay.
So,
Yeah, what really caught my eye right off the bat
Okay.
was that they lead with this original Buffett indicator,
uh-huh.
which is pointing to a potential 5.1%
Yeah.
annual return for the Indian market
Okay.
over the next few years.
So the Buffett indicator,
Right.
that sounds really important, but
It is.
I don't really know what it is. So
Sure.
can you break that down for us?
Yeah, it's basically a way to gauge if the market is overpriced or a potential bargain.
Uh-huh.
And essentially, you compare the total value of all the stocks in the market
Right.
to the country's GDP.
Okay.
It's economic output. Like, think of it as a price tag on the entire stock market.
Okay, so a high ratio means the market's
Yeah.
maybe a little bit too expensive.
Yeah.
And a low ratio
Exactly.
could mean there's room to grow.
Right. And now here's where it gets interesting. Is they also mention a modified Buffett indicator
Uh-huh.
suggesting a slightly higher, like 5.2% return.
Oh.
So that's kind of where things get interesting. Like,
Yeah, a little mystery to kick things off.
Right.
What's the secret sauce in this modified version?
Well, it likely factors in something
Oh,
called
yeah.
valuation reversion to the mean.
Okay.
And basically, that's the idea that stock prices tend to move back towards a historical average over time.
Okay.
So the modified indicator probably includes adjustments
Gotcha.
to account for this tendency,
Okay.
giving us a slightly different projection.
So not all Buffett indicators are created equal.
Exactly.
We've got the OG and the remix.
Exactly.
Makes you wonder how many different versions there are out there. But
For sure.
let's move on to this next piece.
Yeah.
These RVCC parameter
Uh-huh.
they've laid out in this table.
Right. So this is comparing data from December 15th
Okay.
to December 22nd, 2024.
Uh-huh.
And we've got a mix of, like, valuation metrics,
Huh?
market sentiment indicators, and more.
All right. Don't go full data overload on us. Just the highlights. What should we really be paying attention to here?
So let's start with the PE ratio.
Yeah.
The price to earnings,
Mhm.
that tells you how much investors are willing to fork over
Right.
for each rupee of a company's earnings.
Okay.
And looking at the Nifty 50, India's benchmark index,
Right.
the PE went from 22.8 to 21.71 in that week.
So it got a little bit cheaper.
Exactly.
Kind of like find those shoes you've been eyeing go on sale.
Right.
We also see like a similar dip in the price to book ratio.
Uh-huh.
Another valuation measure.
Yep.
So what's the takeaway from seeing both of those going down?
Well, it could signal
Yeah.
that the market is becoming more appealing
Uh-huh.
from a value perspective. But remember, these are just snapshots in time.
Right.
It's like checking the price of a stock once
Right.
you need more context.
Right. You got to look at the whole trend.
Exactly.
Not just a single blip on the radar.
Exactly.
Speaking of context, something else that caught my eye
Okay.
was FII net open interest.
Uh-huh.
That's foreign institutional investors, right?
Exactly. And they can make huge waves in a market like India's.
Yeah.
And this figure tells us whether they're generally bullish
Uh-huh.
or bearish.
All right.
Positive means they're adding to their positions.
Yeah.
Negative means they're selling off.
So it looks like they went from a slight outflow to a net inflow
Uh-huh.
that week. So
yeah.
are the foreign investors getting more optimistic?
That's one interpretation. Could be they're seeing opportunities
Okay.
amidst the recent market dip.
All right. And then we've also got
Right.
the FTY level itself.
Right.
It took a pretty decent tumble,
It did.
going from 24,768 to 23,587 in that
Right.
same week.
Yeah, that's
Wow, that's
not
not
insignificant.
insignificant at all.
Right.
Kind of makes those lower PE and PB ratios we talked about
Exactly.
make a little more sense.
Indeed. But despite that drop,
Okay.
keep in mind the projected returns from the Buffett indicator
Yeah.
are still positive,
Right.
even if they're moderate.
So not a full-blown market crash.
Right.
More like a stobble.
Yeah, like a little bit of a stumble.
Makes you wonder what's driving those dips. And
Yeah.
we've got the VIX,
Yeah,
the volatility index. That went down too.
it did.
What is that telling us?
So the VIX is essentially gauging market jitters.
Okay.
A low VIX usually means folks are feeling calmer.
Right.
high VIX. Everyone's running for the hills.
So maybe investors aren't totally freaking out.
Yeah, it seems like.
But that this nifty wide decline, at least not yet.
Yeah, not yet.
This newsletter also has a notes and observations section.
Yes.
Always love those little nuggets of wisdom
Right.
tucked away in there.
Absolutely.
So what jumped out at you?
So the first thing they suggest is to convert all debt to equity
Okay.
if the Nifty drops below a certain level.
All right. So basically saying,
Right. Basically saying load up on stocks
okay,
when the market's looking cheap.
when the market's looking cheap,
The contrarian approach.
I'm always intrigued by those bold calls.
Right.
Betting against the crowd can be risky,
Yeah.
but also
Could be.
potentially rewarding.
It could be.
What's the logic there? Is it just about buying low
Well,
and hoping for a rebound?
it's about recognizing that market sentiment can be irrational
Okay.
when fear takes over.
Uh-huh.
Prices can drop below
Okay.
what's justified by a company's actual worth.
Okay.
And that's where contrarian investors step in.
So it's like being the bargain hunter at a
Chattel.
stock market yard sale.
Exactly.
Okay, they also recommend focusing on
Right.
large cap and momentum funds.
Yes.
Why those specifically? What's the connection to
Sure.
what's going on in the market?
So large cap funds, those that invest in the biggest companies,
Uh-huh.
tend to be less volatile.
Okay.
It's a way to get some stability
Right.
in kind of toppy waters.
Gotcha.
Momentum funds, on the other hand,
Okay.
chase after stocks that are already on an upswing,
Right.
hoping to ride the wave.
So it's like playing both sides of the field,
Exactly.
getting a bit of safety
Right.
and a bit of that high growth action.
Exactly.
But hold on.
Yeah.
They then go on to recommend specific sectors:
Mhm.
banking, finance, IT, and pharma.
Right.
Why those four? What makes them stand out in the current
Yeah, that's a good question.
market landscape?
That's where we need to dig a bit deeper.
Okay.
It could be anything from their growth prospects
Okay.
to their current valuations,
Uh-huh.
or even regulatory changes that could impact those sectors.
Okay, so we got the who, the what. The WHY is still a bit of a mystery.
Right.
And then there's this equity neutral or positive timeline.
Yes.
And it kind of lays out key dates.
Yep.
Labeled as
Positive, negative,
positive, negative, or neutral
or neutral.
for the market.
Uh-huh.
And it's a bit cryptic, almost like
It is. It definitely.
thanks for a code.
It piques the curiosity.
Yes.
It seems to be pointing to moments
Okay.
when the market sentiment shifted
Right.
based on some sort of analysis that
Yeah.
they're doing,
Uh-huh.
but the exact methodology is unclear.
Okay, so we have this potential treasure map to market trends.
Yes.
But we need to figure out the key to decipher it.
Exactly.
March 8th, 2022 is labeled negative.
Right.
Then is shift to positive on March 17th.
Okay.
And they specifically mentioned April 2023 as the first positive signal for equity
Right.
since December 2022.
Okay.
So what kind of analysis could be behind those labels?
Well, it could be based on anything from technical analysis, where they're
Yeah.
looking at like charts and patterns,
Right.
to fundamental analysis,
Okay.
where they're factoring in economic data
Okay.
and news events.
Gotcha.
Or it could be a unique blend of both.
Okay, it's like they have their own secret formula for reading the market's mind.
Uh-huh.
But to get beyond just the nifty Y50,
Right?
let's zoom out
Oh, wait.
and look at the sectorial index data
Uh-huh.
they've included.
Okay.
This gives us a wider view
Right.
of how different sectors within the Indian market are performing.
Exactly.
And we can compare them based on
Yeah.
key metrics like
PE.
PE,
Right.
PB, and dividend yield.
Exactly.
And that's where we'll pick up in part 2.
Sounds good.
This deep dive is getting more and more fascinating.
It is.
Bide a minute. Join us as we continue to unravel the mysteries of the Indian stock market.
Looking forward to it. So, picking up where we left off.
Okay.
This sectorial index data really allows us
Yeah.
to see the bigger picture.
Yeah.
You know, we're not just talking about
Right.
the nifty 50 giants here.
Okay.
We got mid caps, small caps, even micro caps.
Right. A whole ecosystem of
It's
companies.
the whole ecosystem. Exactly.
It's like going from that bird's eye view
Right.
to actually walking through the different neighborhoods of the
Okay.
market. And
Yeah.
I'm noticing some
Okay.
big differences in the numbers right off the bat.
Okay.
The nifty mid-cap 50, for instance,
Uh-huh.
has a way higher PE ratio
Right.
than the nifty 50.
So that higher PE suggests
Okay.
investors are willing to pay a premium
Okay.
for the growth potential.
Right.
they see in mid-sized companies, they might be expecting those companies to expand more quickly than the already established large caps.
Makes sense. It's like betting on the
Exactly.
up-and-coming startup versus the steady blue-chip company.
For sure.
But let's bring this back to those 4 sectors that the newsletter highlighted.
Okay.
Banking, finance, IT, and pharma. Does this data back up their focus, or does it point us in a different direction?
Yeah, that's the million rupee question, isn't it?
It is.
So let's start with banking.
Okay.
Now, the Nifty Bank Index
Okay.
isn't specifically listed here,
Right.
but it usually moves pretty much in sync with the Nifty 50.
So given that the Nifty 50 took a dip,
Right.
we can probably assume that the banking sector felt the tremors too?
It's a reasonable assumption.
Okay.
But to really understand what's going on in banking, we need more than just a broad market index.
Right.
We'd want to look at factors like interest rates, loan growth, and the overall health of the financial system.
Right. Banking is always tied so closely
to
the economic pulse of a country.
Right.
Okay, so we've got a bit of a question mark.
Yeah, for sure.
Hanging over banking for now. What about finance?
Oh, okay.
That's a pretty broad category.
Absolutely. Finance covers everything.
Right.
From insurance companies to asset managers.
To those non-banking financial companies or NBFCs.
Okay.
To get a clear picture.
Okay.
We need to break it down into those subsectors.
Right.
And see what's happening.
Yeah.
At that granular level.
So maybe some hidden gems or red flags.
Could be. Could be.
Lurking within that broad finance category.
Yep.
We'll have to keep our detective hats on for that one. Next up, IT.
Okay.
That's been a powerhouse.
Yeah, has it?
For India for quite some time.
For sure.
Riding that global tech wave.
Right.
What clues does this data give us about IT's current situation?
One thing to keep in mind is that Indian IT is heavily reliant on what's happening overseas.
Okay.
Especially in the U.S. and Europe.
Right.
Their economies sneeze.
Right.
India IT might catch a cold.
Globalization in action.
Exactly.
So it's not just about what's happening within India's borders.
For sure.
We've got to keep an eye on
global tech spending, economic forecasts.
All of it. Yeah.
The whole shebang.
The whole thing.
And we also want to look at
how
Indian IT companies are adapting to things like
like
automation,
AI, automation,
and the constant evolution of technology.
Yeah. Are they staying ahead of the curve?
Right. You've got to make sure they're not just riding yesterday's tech wave.
For sure.
All right. Lastly, we have pharma.
Okay.
Often seen as a defensive sector.
Right.
Kind of a safe haven.
Right. A little bit of the safe haven.
When the market gets rocky.
Exactly.
But what's the story here in India?
So the pharma sector in India faces its own unique set of challenges. There's intense competition, both domestically and from international players. And then you've got factors like pricing pressures, regulatory changes, and the constant need to invest in research and development.
So even pharma, the supposed steady Eddie, has its own set of hurdles to overcome.
It does. It does.
It makes you realize there's really no such thing as a truly risk-free investment.
Risk is inherent in any market.
Right.
It's about understanding those risks and deciding what level you're comfortable with.
Right. But going back to the newsletter's sector recommendations.
Yeah.
I'm wondering, does this data really support their focus on banking, finance, IT, and pharma?
Yeah,
or are there other sectors?
That's a great question.
That are flashing signals that they might be missing.
Yeah, it's like they've given us a starting point.
Right.
But now it's up to us to do our own due diligence and see if their thesis holds up.
Yeah, maybe there's a hidden gem.
Exactly.
In a sector they didn't even mention.
For sure.
And that's the beauty of this, isn't it?
It is.
We're not just passively absorbing information.
No.
We're actively engaging with it.
Exactly.
Questioning it. And using it to form our own conclusions.
I love it.
This deep dive is turning into a full-blown treasure hunt.
It is. It is.
We've got the map.
Yeah.
We've got our tools.
We do.
And now it's time to explore.
Let's go.
And see what we can uncover.
Exactly.
But we're not done yet.
Okay.
There's still more to this newsletter to unpack.
Sounds good.
And we'll be back in part 3 to dive even deeper.
Can't wait.
We've covered a lot of ground already.
We have.
From Buffett indicators to sector deep dives.
Yeah.
But there's one piece of this newsletter that I keep coming back to.
Okay.
That modified Buffett indicator.
Yeah.
It's got me thinking, are we really just scratching the surface when it comes to understanding the market?
You know, that's a great observation.
Yeah.
The fact that they even have a modified version suggests there are multiple ways to interpret and analyze the same data.
Yeah.
It's like looking at a sculpture from different angles.
Right.
Each perspective gives you a new understanding of the whole.
And it makes you realize that no single indicator or expert
for sure
has all the answers.
Exactly.
It's about piecing together different viewpoints, different methodologies, and even challenging
for sure
those well-established norms.
Absolutely. Think of it this way. The modified Buffett indicator likely incorporates additional variables or adjustments specific to the Indian market. It might be accounting for factors the original indicator misses, leading to a slightly different outlook.
So it's not just about blindly following a single metric.
Exactly.
It's about understanding the underlying assumption.
The methodology.
And recognizing that there's always room for different perspectives.
Which begs the question, what other indicators or analysis methods could provide additional insights into the Indian stock market? That's the exciting part. There's a whole world of analytical tools out there. There are alternative valuation metrics beyond just PE and PB. There are technical indicators that look at price trends and patterns. There are macroeconomic models that factor in things like interest rates and inflation. It's about finding the tools that resonate with your investment style and digging deeper.
It's like having a whole toolbox.
Exactly.
At your disposal.
You
wouldn't just use a hammer for every job.
Exactly.
You'd choose the right tool for the task at hand.
Exactly. And the more tools you have in your arsenal, the better equipped you are to tackle the complexities of the market.
This newsletter has definitely given us a lot to think about.
For sure.
But more importantly, it sparked a sense of curiosity.
I love that.
A desire to go beyond the surface and explore the depths of market analysis.
And that's what we hope you take away from this deep dive.
Absolutely.
The Indian stock market is a dynamic and ever-evolving landscape. There's always more to learn.
For sure.
More to discover. And new ways to approach the challenge of understanding where it's headed.
It's a journey.
It is.
Not a destination.
Exactly.
So as we wrap up this deep dive, we encourage you to keep an open mind.
For sure.
Question assumptions. And to continuously seek out new knowledge.
That's it.
Remember, data and analysis are essential tools. But investing also requires a healthy dose of intuition, discipline, and a long-term perspective.
Could not have said it better myself.
Thanks for joining us on this exploration of the Indian stock market.
It's been a pleasure.
We hope you've gained valuable insights.
Absolutely.
And a renewed sense of curiosity. Until next time.
Happy investing.